Roles of the Federal Reserve and U.S. Treasury. The Federal Reserve and the U.S. Treasury are central pillars of the American monetary system, collaborating to manage currency issuance, debt, and economic stability, ensuring the smooth operation of a $150 to $200 trillion economy. The Federal Reserve, established through the Federal Reserve Act of 1913, serves as the nation's central bank, with a mandate to regulate commercial banks, set monetary policy, and stabilize financial markets. It oversees the fractional reserve banking system, which allows banks to lend beyond their reserves, typically holding 10% as mandated, creating a $21.560 trillion money supply in January 2025. The Fed sets interest rates, fixed at 4.75% to 5% in 2025, to influence borrowing costs and economic activity, encouraging lending during slowdowns or tightening to curb inflation. Through open market operations, conducted by the Federal Open Market Committee, the Fed purchases U.S. Treasury securities, crediting bank reserve accounts to inject new money into the economy, supporting the $45.560 trillion federal debt and stabilizing bond markets by preventing sell-offs at a loss. The Federal Reserve generates substantial revenue to fund its operations, primarily through interest earned on its portfolio of Treasury securities, agency debt, and mortgage-backed securities. For instance, a $1 billion Treasury bond yielding 4% generates $40 million in annual interest, constituting over 90% of the Fed's income. Additional revenue streams include fees for financial services, such as check clearing, automated clearinghouse transfers, FedWire funds transfers, and the FedNow instant payment system, which collectively generated $500 million in 2023. The Fed also earns interest on discount window loans, serving as a lender of last resort to banks facing liquidity shortages, and on foreign currency investments, reflecting the dollar's global role with $8 trillion held in foreign reserves. These revenues fund operational costs, including $1.1 billion in employee salaries, $1 billion for currency production, and $700 million for the Consumer Financial Protection Bureau in 2023. After covering expenses and paying $1.5 billion in statutory dividends to member banks, the Fed remits excess earnings to the U.S. Treasury, contributing to the $5 trillion in federal revenue in 2024 and reducing the $1.9 trillion deficit. The U.S. Treasury complements the Federal Reserve's role by managing the physical production of currency and fiscal operations. The Bureau of Engraving and Printing, under the Treasury, produces Federal Reserve notes at a cost of $1 billion in 2023, ensuring banks have sufficient cash to meet public demand for withdrawals and transactions, a small fraction of the digital money supply. The Treasury's Secret Service plays a critical role in combating counterfeiting, maintaining public trust in the dollar's integrity, which is essential for its acceptance in domestic and international markets. The Internal Revenue Service, another Treasury component, collects taxes, generating $5 trillion in 2024, which funds government programs such as infrastructure, defense, and social services. However, when tax revenue falls short of federal spending, resulting in a $1.9 trillion deficit, the Treasury issues bonds, notes, bills, and bonds to borrow funds from banks, individuals, and the Federal Reserve. These bonds, part of the $45.560 trillion federal debt, finance public services and ensure fiscal continuity. The Federal Reserve structure is a unique hybrid of public and private elements, designed to balance independence with accountability. The Board of Governors, a federal agency, consists of 7 members appointed by the President and confirmed by the Senate, overseeing national monetary policy and regulatory functions. The 12 regional Federal Reserve banks, structured like private corporations, are owned by member banks, which hold stock and receive 6% dividends, totaling $1.5 billion in 2023. This hybrid model, established in 1913, allows the Fed to operate without congressional funding, relying on its revenue to cover expenses. Oversight is provided through congressional hearings, Government Accountability Office audits of non-monetary operations, and public disclosures like the Fed's annual report and weekly balance sheets, though monetary policy decisions are exempt from direct audit, sparking debate over transparency. The collaboration between the Fed and Treasury, rooted in their complementary roles, ensures liquidity, currency reliability, and economic stability, replacing the chaotic banking environment of 1836 to 1913 and supporting modern financial demands. The partnership between the Federal Reserve and the U.S. Treasury is critical to the monetary system's success, integrating monetary policy with fiscal operations to sustain economic fluidity. The Fed's management of interest rates, bond purchases, and currency supply, combined with the Treasury's currency production, tax collection, and debt issuance, forms a cohesive framework that drives the economy. This interplay, built on the foundation of the 1913 Act, addresses historical challenges like counterfeiting and instability, ensuring the system can support a globalized economy while navigating the complexities of modern finance. Understanding these roles provides insight into the broader dynamics of currency valuation and revenue generation, which are essential to the monetary system's operation.